So, let's define the price levels, where the trader should place the orders used for opening and closing positions, in accordance with the rules of double-barrel gun trading strategy. On the next slide, you will see the layout of pending orders used for opening a long position. For the sake of simplicity, the price line is not shown in the diagram. First, let's consider the situation number 1. In this case, trader should pay his attention to the following things. The uppermost line, with the parameter of 20 time intervals, blue. The lowermost line, with the parameter of 200 time intervals, green. And the distance between them, so-called buffer zone. If the distance between these lines is 10% of ADV or less, then, trader should use the diagram provided on the slide to calculate the price levels, where the orders used for opening and closing a position will be set. Of course, in addition, trader should also calculate the amount of the transaction. Otherwise, if the distance between these two lines is greater than 10% of ADV, then, trader should not place any orders at all, because in this case, the risk per trade will be higher than acceptable, which in turn reduces the mathematical expectancy of the strategy. The shorter the distance between the uppermost and the lowermost lines, the better, because the smaller will be the value of the stop loss needed for this position. Thus, in accordance with the diagram provided on the slide, the opening order for a long position will be set at a distance of 15% of ADV above the uppermost moving average. The take-profit order will be set at a distance of 33% of ADV above the opening order. Accordingly, the stop-loss order will be set below the lowermost moving average at a distance of 20% of ADV. Trader should take into account the spread while placing all buy orders. Please remember that the main order used for opening a position is active and will be executed only after the price reaches the order, while the pair of remaining orders used for liquidating a position are in a standby mode and will become active only after the main order is triggered. Now let's consider the situation number 2. In case the short-term moving average with the parameter of 20 time intervals enters into the space between two long-term moving averages with the parameter of 200 time intervals, then, trader should define the distance between two long-term moving averages, red and green. In the situation number 3, short-term moving average crosses two long-term moving averages, thus generating a formal signal of trend reversal. However, death cross signal generated by these moving averages is not clear enough. Therefore, in this particular situation, in accordance with the rules of the strategy, trader still has to be ready to open a long position. A little later, I will voice a criterion, according to which trader determines whether golden cross or dead cross signal generated by moving averages is true or false. But in the situation number 3, as well as in the situation number 2, trader should take into account the distance between two long-term moving averages. On the next slide you can see the layout of pending orders used for opening a short position. Here, the arrangement of pending orders is mirror opposite to the diagram discussed above. Sometimes, there are situations when it's quite difficult to determine the fact of continuation or termination of an old trend, while judging only by the rules described above. The problem is that moving averages used in double-barrel gun trading strategy quite often generate not very clear golden cross or dead cross signals, which cannot confirm the fact of change in the direction of an old trend. Take a look at the chart on the left. Here the market was in a downtrend. Then, in the process of price correction, the short-term moving average EMA20, represented by the blue line, has moved slightly above the long-term moving averages EMA200 and SMA200, represented by red and green lines. Speaking formally, this golden cross signal represents the end of a downtrend. However, in fact this signal is false, since the size of the buffer zone formed by the lines of blue and green color is less than 10% of ADV. As you see, this parameter is the main criterion for interpreting golden cross and dead cross signals in double-barrel gun strategy. In order to ensure the accurate and fast calculation of all price levels needed for placing orders, trader can use a special table, an example of which is shown below. In this table, trader must specify the 4 technical parameters of the trade: the current price of the instrument, its volatility, the value of the uppermost and the lowermost moving averages. After that, trader will get a new set of technical parameters of the trade: the distance between the uppermost and the lowermost moving averages, as well as the price levels of all 3 orders that should be placed before the trade: open, stop loss and take profit. In addition, this table can also be used for calculation of the lot size, potential profit and risk of the trade. Now, let's review the algorithm of traders' actions before opening a position. 1. Determine the current level of volatility in the instrument, ADV. 2. Calculate the difference between EMA20 and MA200, or between EMA200 and SMA200. 3. Determine the level of position entry order. 4. Determine the level of stop loss order. 5. Determine the level of take profit order. 6. Place all necessary orders. 7. Correct the price values of pending orders, if needed. Now let's see how the strategy works in action. The first slide shows where and when should be placed all pending orders. The second slide shows when the entry order is triggered and what happens next. As you can see, the OCO orders are activated simultaneously after the entry order is executed. The third slide shows when the take profit order is executed and what happens next. As you can see, the stop loss order is cancelled automatically after the take profit order is executed. The next 3 slides demonstrate how the strategy works in case of a long position.